Josh, so we got within a point. Same narrative here. Apple new high, NVIDIA new high. What now? We figure we're going to hit a new high for the S&P. The question is, then what?
Yeah, those stocks are really all you need to get it done, like a nominal new high in the S&P. I thought this was interesting. It's been 122 days since the last time the S&P 500 had an all-time record closing high. And if you think about the median number of days for the S&P 500 between making those closing new all-time highs, it's usually about 90 from one year to the next. So I guess I would say this is a pretty average year, all things considered, if you forget about that little episode that took place in March and April. So I would not be surprised to see an all-time record close for the S&P very soon. And what you need to get there, it's all working. One other thing I would throw into the mix, and this is insane, put to call ratios have just completely collapsed. And it's a historic collapse. And I think it's indicative of sentiment out there. People are just no longer afraid of a resurgence in the virus or a spate of negative headlines that are going to send us lower. And the evidence of that is, if you look at a 50-day moving average of the put-to-call ratio, you really have to go back 15 years to find a period of time during which it was this low. You have to go back, Scott, to 2004. So I'm not saying that means excess bullishness, but I am saying that does mean an excess in complacency. And you see these case by case reports from each state. We had a spike in New Jersey at the end of June. California is ticking up again. We had a death rate tick up. Investors truly are looking right past it. They are no longer buying protection out there. I'm sure the Najarians would say this is the time that you should buy protection if no one else wants it. But I'll leave that topic to them. That's what's happening right now.
Yeah. Kerry, how about that? Are people too complacent? I mean, we have no deal in Washington. We don't seem anywhere close to an agreement on more stimulus, and the market yawns day after day after day. Doesn't seem to care about anything.
Well, the market seems to assume that we will get another stimulus. That's definitely in the price right now, and we can't hit a new high unless we get that stimulus. And also, as we've talked about before, the market needs to broaden. So it's interesting. If you look at a little chart Vin pulled together for me of how the parts of the market has reacted, and we can see that since the beginning of the quarter and the beginning of August, meaning a week and a half ago, over 50% of the names in the S&P are ahead of the S&P index. And that compares to 36% of names beating the index from the beginning of the year. So we've had a very definite shift and broadening of this market away from just the COVID-helped stocks like Amazon and Netflix to many more cyclicals and names that will be recovery stocks. So again, people are betting on those companies that will be able to come back and grow, whether it's airlines or banks or other types of financials that are going to help carry that market. And of course, as you said, the market is assuming that we get that stimulus, interest rates stay low, and we don't have to shut down totally.
So it's a good point, and it clearly has to be one of the catalysts that you need for stocks, Degas, to take that next leg, right? Let's assume we get to this record close on the S&P. We're so close, one would think that we would get there. And the question is now what, right? Where do we go from there? So Kerry cites this broadening rally. You're going to have that if you think you can take even another leg higher. The problem is when you look for the next catalyst, I've got my list here. Earnings are all but over. Lots of good news clearly is already baked into the market. The economy's far from back, and the path forward remains very uncertain. So what's going to take you there?
Yeah, Scott, what we're seeing is that in March 13th, we actually saw that the high valuation stocks actually took the lowest point. And what we've seen since March 13th until now is just a recovery. So what we're saying is that the surge in the market, we're going to see a slowdown. We're going to see it go back to what we typically look at in a market environment, whereas we have valuation may still be a positive contributor, but we don't see it as the surge that we've had in the last 2 to 3 months. And so we're seeing a calming of the market. We're going to be in a range because we're also seeing that the high profitability stocks are once again taking the lead in the market, and we're going to see some more positive relative to high profitability stocks relative to low probability stocks, and we're seeing that going forward.